The Great Depression. On the morning of October 29, 1929, the air in Wall Street was thick with tension. The once booming stock market, an unstoppable force of wealth and ambition, suddenly crumbled. Black Tuesday had arrived. In a matter of hours, fortunes vanished. Men in crisp suits stood in disbelief, watching stock prices plummet. The trading floor erupted into chaos as panic spread like wildfire. But this wasn't just a bad day on Wall Street. It was the beginning of the worst economic catastrophe in modern history. For years, America had been riding high on the wave of the Roaring Twenties, an era of soaring stocks, easy credit, and boundless optimism. Everyone wanted in. Ordinary people poured their savings into the market, believing stocks could only go up. But beneath the surface, danger loomed. Speculation ran rampant, and banks, hungry for profits, recklessly lent money to investors who had no means to repay. The market had become a fragile house of cards, and on that fateful October day, it all came crashing down. As stock prices collapsed, the domino effect began. Banks, heavily invested in the market, failed one after another. Families rushed to withdraw their life savings, only to find locked doors and empty vaults. Businesses crumbled. Jobs disappeared. Unemployment skyrocketed to a staggering 25%. Breadlines stretched for blocks. In rural America, farmers lost their land to ruthless foreclosures, while the Dust Bowl turned once fertile fields into barren wastelands. The pain wasn't confined to the U.S. The Great Depression rippled across the globe, shattering economies from Europe to Asia. Nations turned inward, raising tariffs in desperate attempts to protect themselves, but instead, they suffocated global trade. For years, governments scrambled for solutions. In America, President Franklin D. Roosevelt launched the New Deal, a bold experiment of public works, financial reforms, and social safety nets. It was a lifeline, but recovery was slow. Ultimately, it wasn't policy but war that ended the Depression. The outbreak of World War II reignited industry, fueled mass employment, and restored economic stability. The 1973 oil crisis. In October 1973, a silent but devastating weapon was unleashed, not with bullets or bombs, but with barrels of oil. The Organization of Arab Petroleum Exporting Countries, OAPEC, turned off the taps, imposing an embargo on nations that supported Israel during the Yom Kippur War. Almost overnight, the world's most powerful economies found themselves gasping for fuel. What followed was economic chaos on an unprecedented scale. Oil prices didn't just rise, they quadrupled, jumping from $3 per barrel to nearly $12. Gas stations in the United States became battlegrounds. Endless lines of desperate drivers snaked around blocks, waiting hours for a ration tank of gas. Some stations ran dry. Others imposed limits. Suddenly, a routine trip to work or the grocery store became a costly decision. But the crisis was more than just an inconvenience at the pump. It sent shockwaves through the global economy. The cost of everything, from food to transportation, skyrocketed. Businesses, crippled by soaring production costs, cut back on operations. Jobs vanished. Inflation soared. Growth stalled. Economists scrambled for answers as the world faced a terrifying new reality. Stagflation, a rare and devastating mix of stagnant growth, rising unemployment, and runaway inflation. This wasn't just an oil crisis, it was an energy wake-up call. Industrialized nations had long relied on cheap Middle Eastern oil, but now that dependency had turned into a vulnerability. Governments were forced to rethink their energy strategies. The crisis pushed the world toward new solutions: fuel efficiency, alternative energy sources, and strategic oil reserves. The power dynamic had also shifted. Oil exporting nations, once seen as suppliers, had become economic kingmakers, holding immense leverage over the world's most powerful economies. The 2008 global financial crisis. It started with a dream: home ownership for everyone. In the early 2000s, banks and lenders fueled an unprecedented housing boom, handing out mortgages to anyone who asked, even those with shaky credit. Home prices soared, and Wall Street saw an opportunity. Instead of questioning the house of cards they were building, financial institutions doubled down. Banks bundled risky subprime loans into complex financial products called mortgage-backed securities, or MBS, and collateralized debt obligations, or CDOs. These were then sold to investors around the world, stamped with AAA ratings by credit agencies that either didn't understand or didn't care how fragile they really were. For years, the system seemed unstoppable. Investors profited. Banks thrived. Homeowners believed prices would never fall. But cracks began to show in 2006 when housing prices peaked. As values dropped, homeowners found themselves owing more than their homes were worth. Mortgage defaults surged. Then came 2008, the year the world unraveled. Lehman Brothers, a giant investment bank, collapsed overnight, sending shockwaves through global markets. The financial system, built on bad debt and reckless speculation, froze. Banks stopped lending. Stock markets nosedived. Trillions of dollars vanished. Governments scrambled to prevent total economic collapse. The U.S. government poured $700 billion into failing banks through the Troubled Asset Relief Program, TARP. Central banks slashed interest rates to near zero. Stimulus packages flooded the economy in a desperate attempt to restore confidence. But for millions, the damage was done. Homes foreclosed. Jobs disappeared. Savings evaporated. The crisis plunged the world into a deep recession, exposing the greed, poor oversight, and systemic fragility that had fueled the meltdown. In the aftermath, governments imposed tighter regulations, including the Dodd-Frank Act, aimed at preventing another catastrophe, the COVID-19 pandemic. At the start of 2020, the stock market was unstoppable. The S&P 500 and Dow Jones were soaring to record highs, fueled by a strong economy and investor optimism. But in the shadows, an unseen threat was spreading, one that would bring markets to their knees faster than ever before. In late 2019, news of a mysterious virus emerged from Wuhan, China. At first, few paid attention. The markets shrugged off the headlines. But as February 2020 arrived, the virus spread beyond China to Italy, Iran, and the rest of the world. What seemed like a distant health crisis suddenly became a global emergency. Then came March, the month the markets crashed. Panic erupted as governments locked down entire economies. Businesses shuttered overnight. Supply chains froze. Investors, fearing a worldwide recession, rushed for the exits. Within weeks, stock markets crumbled. The Dow Jones suffered its three worst single-day point drops in history: March 9th, March 12th, and March 16th, falling nearly 13% in a single session. These days became known as Black Monday, Black Thursday, and Black Monday again. Just when it seemed things couldn't get worse, an oil war between Saudi Arabia and Russia sent oil prices into freefall, adding more fuel to the fire. It was chaos. But governments and central banks fought back. The U.S. Federal Reserve slashed interest rates to zero and unleashed massive stimulus programs. Congress passed the CARES Act, a historic $2.2 trillion rescue package that sent direct payments to citizens and propped up businesses. Around the world, policymakers scrambled to contain the economic fallout. Despite the devastation, something extraordinary happened. By April, whispers of vaccine development and the rise of the stay-at-home economy, led by tech giants like Amazon and Zoom, sparked a historic rebound. Stocks climbed at a record pace. By August 2020, the S&P 500 had fully erased its losses, marking the shortest bear market in history. But beneath Wall Street's recovery, Main Street was suffering. Small businesses collapsed. Unemployment soared. The crisis exposed a deep disconnect between financial markets and the real economy, a divide that still lingers today. The COVID-19 crash wasn't just a financial meltdown. It was a reminder of how fast fear can spread, how crucial government intervention can be, and how unpredictable the global economy truly is. Because in 2020, the markets didn't just fall. They plummeted, rebounded, and left the world forever changed. History has shown us, again and again, that no economy is immune. Crashes happen fast, recoveries are slow, and the lessons are often forgotten. So the question is, what will trigger the next collapse? Make sure you're prepared. Hit subscribe and join us as we break down the past to predict the future better.